Hello, hello, Dan Passarelli here. How are you feeling today? Today, we've got a treat. We're going to talk about winning post-election trading strategies, and I think it's going to be a fun conversation and an informative conversation. And well, let's just get started. Before we get started, I was teasing you. Before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Also, don't trade with money you're not prepared to lose. And what we're doing today is giving general advice without knowing your situation. I cannot give you advice that is personal to you. Now, for those of you who are not familiar with me, let's take a look at who's in the house here today. Oh, I see some familiar names here. But for those of you who are new to this and just joining me for the first time, allow me to introduce myself. My name is Dan Passarelli, and I am an author of two of the top trading books, Trading Option Greeks and The Market Taker's Edge. And I'm a trader. Always have been. I was born a trader. Not really. But I have been doing it since I was about 20 years old, or maybe a little younger, I think. I traded on the floor of the Chicago Board Options Exchange, Chicago Board of Trade, CME Group. And several years ago, I founded Market Taker Mentoring, which is the global leader in option trader education. And I collaborate with a lot of good people in the industry, including top brokerage firms that allow for option trading, like Firstrade. And I'm a family man. My wife, Kathleen, that many of you know, and my two kids, adult children, two cute little dogs. And I'm a runner, foodie. That's why I have to run to burn off all those calories. Traveler and musician and music fan to boot. Now, I want to give you an ethical bribe. I want you to really, really like this presentation and keep coming to all of my trainings and tell all your friends about it. So I'm going to give you something. We have a webinar tomorrow that I'd like to give you a free invite to. It's called Smart Money Investors Are Doing This to Lower Post-Election Risk. It's going to be a different presentation than what we're doing today. And that class is tomorrow. So go to markettaker.com/REG, short for register. It's market as in stock market. Taker as in take what's rightfully yours, two T's in a row, markettaker.com/REG, and get registered for tomorrow's webinar. Okay, so we are going to be talking about the election that is happening today. And here is what I want, and here's what I don't want. I want you to know that what we're talking about is trading. Politics, we vote with our hearts, right? What we're passionate about, what we care about, how we feel towards a candidate. That's politics. We're not going to do that today. What we're going to talk about is trading, which never comes from the heart. It's never how you feel. It's always a system of logic. It's brain power. And that is what we're going to do today. So I am not a real partisan sort of fella. Anything that I say positively or negatively about a candidate doesn't mean that I love him or hate him, because I don't. So don't get yourself all worked up if there's something, that could be misconstrued as a criticism of the candidate that you support or love or whatever. All right. So let's talk about uncertainty. Markets hate uncertainty. Plain and simple. That, I think, is why we've had so much volatility lately. I mean, uncertainty is what leads to volatility, is it not? And leading up to today, we've had uncertainty, and I think that's why we had some volatility. And for those of you who have been in options for a while, you probably know that when the market goes up, volatility goes down. When the market goes down, volatility goes up. Well, it's kind of the same with uncertainty, really. When markets are uncertain, we see, about something like an election, we tend to see markets go down. So what do markets do following elections? Well, I'm glad you asked that question, because I have a friend who knows every single political statistic from the past 80 years. Really, is a very impressive friend of mine. And her name is ChatGPT. And my good friend ChatGPT, in answering my question, says, well, Dan, here are the years when the S&P 500 rallied within 1 week following the US presidential election. Now, this goes back to 1952, which is 70 years, 71 years, 72 years rather. And elections are every 4 years. So all we have to do is look for the years that are more than 4 in a row. Those are the times when the market did not rally after an election, within 1 week. So here's 4 years, 4 years, 4 years. Oh, 1968, it did not rally. Okay. 72, 1976, it did not rally. 80, 84, 88, 96. 92, it did not rally. 2000, it did not rally. So what is that? 5? It rallied 13 times, and it did not rally 5 times. So typically, following an election, within 1 week, the market rallies. And I also want you to take a look and count the R's and D's. It's not very much related to whether there's an R or D after the person's name. The markets are not necessarily rallying based on policy. It's rallying based on the end of uncertainty. Now, it could be we don't have an answer by morning. And if we don't, I would suspect the market sells off. A little bit, not a lot. If we do have an answer by morning, I would suspect that the market probably rallies pretty strongly, regardless of who it is. So this is a left brain data-based observation. You might hate the one person and love the other person, or vice versa. Doesn't matter. The numbers say the market's more likely to rally. All right, now let's talk about economic stimulus and inflation. What causes inflation? Anybody? What causes inflation? I'll tell you what causes inflation. Inflation is caused by the economy being too hot. When you got full employment and everything's going great, companies say, man, people are buying the crap out of our products. Let's raise the price, see if they still pay that. That's what companies do. That's how they deliver value to their shareholders. Or if it's a non-public company, value to their owners and partners. And so that, so that's products, everything's going good. They raise their prices, works with labor too. Hey, man, this is a hot economy. I could quit my job and get a job making more money somewhere else. I'm going to go ask for a raise. And they give them the raise. So that is basically what the Fed has been fighting against. And it seems counterintuitive, like we want a good economy, but if it's too good, we get inflation, and that's not good. So the Fed has raised rates and has been talking about raising rates to cool the economy, both of those things. Companies saying, man, people pay anything for us, though. Let's raise our prices. And workers saying, yeah, man, it's a hot labor market. I'll go get a job making more somewhere, or I'll ask for a raise. So the Fed's been raising rates and talking about raising rates to cool that, including and maybe even especially wage inflation by tightening employment. When markets or when interest rates rise, it's harder for companies to borrow money. So consequently, companies spend less money on workers and other things. So like I said, you might love this candidate, hate this candidate. I don't care. I'm not talking about, I don't love or hate either of them. And if I did, it wouldn't affect my trading regardless. We trade with this, right? So we try and get clear information. Now, I don't really watch the news outlets that are designed to amp up your emotion. I try and keep it pretty neutral because all I want is the facts. All I want is data to trade. So from my sources, I believe it's widely believed that both candidates are likely to increase debt. Now, maybe you listen to some news source that says, no, this person's going to eliminate all the debt and, ride a unicorn into Washington, whatever, maybe a different news than what this says here, but I think it's generally expected that both candidates are likely to increase debt. Debt is borrowing money. Why are they borrowing money? To put it under the mattress in the Lincoln bedroom? No. To spend it, which increases economic activity. Debt is inflationary. By most accounts, and again, just looking at data, and you can say, no, this person's terrible and the economy's terrible, but it's not based on data. The economy's doing well. It's cooled a little bit intentionally because of the actions of the Fed, which were intentional. But if the economy's doing pretty good and the Fed has been bringing inflation down, borrowing money and spending it, and hiring more people and paying more money, that's working against the Fed. Debt is inflationary. So here's where I'm going to give you some tips. So there's greater potential for inflationary pressure because of really several reasons. First of all, more debt. Now, as far as more debt goes, again, it's widely believed that both candidates are going to add greatly to our already dangerous debt. It is thought by most sources that Trump would borrow more money. And if you disagree, that's fine. I'm just going off what I've read. And then lowering taxes. When the government doesn't take money away from you, you have more money to spend. You spend more money, that heats up the economy. Lowering taxes, which, again, I'm only speaking in terms of inflation. Lowering taxes is inflationary. I don't want to give any political whatever, but, like, if it's up to me, I'd rather pay lower taxes than higher taxes. But, lowering taxes is inflationary. The tariffs proposed is inflationary, both in the short term and the long term. Now, again, this is not my opinion about whether tariffs are good or bad. This is just one element of that thing. In the short term, imported goods become more expensive with tariffs. That's pretty straightforward. In the long term, and what I think is probably the objective of these tariffs, is to get rid of some of the bad deals that were made in the past, which was both parties, so that American manufacturing can be a thing again and more blue collar jobs. Now, all that's also inflationary. Americans get paid more than Chinese people for performing the same functions. So the goods end up being more expensive in the long run too. Doesn't necessarily mean tariffs are bad. That's just one part of it. But it's an important part. Also, influence over the Fed. One candidate, Trump, just a few days ago said that he would try and influence the Fed, and that's within his right. And he tried last time to get the Fed to lower interest rates faster, which could add to inflationary pressure. So again, just looking at one thing, inflation, and this is a little bit more skewed to Trump. And then there's going to be a slide that's more skewed to Harris, so I'm not picking on anybody. This is inflationary causes. But inflation benefits assets in dollar terms. So again, not talking about this because I have any opinion on a candidate or any policies. Talking about this because this is going to be an important investing key for you. Inflation benefits assets in dollar terms, because if you think about it, it's not really that things are getting more expensive. It's that the dollar's buying power is going down. It costs more dollars to buy the same things because dollars are not worth as much. So that means that if there is inflationary pressure, companies can charge more for their stuff. So even if they sell the same number of units, when their earnings come out, they will have sold more dollars worth. Inflation is actually good for the stock market. Why do you think the market has been up so much this past year? That's one reason. That's not the only reason. Another reason was because the Fed was looking to cut interest rates. But stocks, houses, those all benefit from inflation. Inflation still probably hurts. I mean, inflation does still hurt the individual and the company and everything else. But in dollar terms, stocks get worth more. And that's pretty interesting. So I bring this up because if and when you see some of these things happening, it'll be a process. It takes time for, some of these things to play out, 3 to 6 months. Some things like interest rates can take 6 months to a year. But all this stuff, while it could be bad for you, some of these things not. Some of these things could be bad for you. Some of these things could be good for you. But the stock market will have some wind in its sails. Okay. So now there was a proposed unrealized capital gains tax. And so this is something Harris proposed, and I read about it online, and it seems like maybe it's still not 100% fleshed out, I guess, because there were some things that I was trying to figure out how they could actually be done. But like, you pay capital gains on stocks. If like, say you inherit 1,000 shares at Disney that your grandfather bought, in 1962, and it's split 25 times since then, and you own it at a cost basis of like 2 cents, right? If you sell those shares, you have to pay capital gains tax on it. If you don't sell those shares, you don't, as of the law right now. That would be different, as I understand this. And it has market implications, which is why we're talking about it. That would be different if it's unrealized capital gains tax. That would mean at the end of the year, wherever the stock was valued on December 31st when the market closes, you pay capital gains tax on that. Now, there's some things to talk about here. First of all, it may only affect the top 1% wealthiest. They said anybody with more than $100 million, I think it was, of net worth are the only ones that will be subject to this. I don't know how that works because you don't put your net worth on a tax return. So I think there's still a lot of questions there. And, to be fair, politicians, both sides, say they're going to do things, and sometimes they put them into action right away. Sometimes they just stop talking about it and it goes away. Sometimes it, goes into Congress or whatever and falls apart or gets picked up. You never know what's going to happen. But if this did go into action, even if it was for only the 1% top wealthiest, I mean, when they buy and sell stocks, that creates more buying or selling pressure than me and you. So if you know that, like, oh, hey, I inherited this Disney stock from my grandfather at a cost basis of 2 cents, well, whatever it's worth on December 31st, I'm going to have to pay taxes on that. So I don't need to like hold this stock to avoid taxes. I'm just going to sell it. I'm going to get taxed anyway. So it eliminates a need to hold stocks to avoid capital gains tax. That's one of the reasons why our tax system is set up this way for capital gains tax, because it gives strength to the market. It props up the market. So that's a thing that props up the market would disappear. It creates greater instances of selling pressure because there's no need to hold it anymore. It doesn't benefit you. So that overall will weigh on stock prices. So if this ends up going into play, that would be a negative for the stock market. And this one I have an opinion on, but I'm not expressing an opinion. I'm just saying that it would be more bearish for stocks. We would want to start looking into call credit spreads and such. Okay. I got a question, Q&A. Hiring enormous amount of federal employees adds, yeah, well, not infinitely to inflation, but yes, absolutely. It is definitely inflationary. Yep. Okay. Okay, next. So what industries are more likely to benefit if whichever candidate is successful? So Trump, traditional energy. He's made no bones about it. I think drill, drill, drill was one of the quotes. So start looking at oil stocks, financials. Generally speaking, Republicans in general tend to be more relaxed on regulation. Where they like less regulations, which is good for companies. You can make a case for, is it good or bad for the system? And that could be an interesting conversation, but it's a different conversation. Crypto. American manufacturers. That's the whole point of these tariffs, right? To have more American manufacturing and less offshore. And then prison operators. I guess that's a thing for Trump. So these industries, or some are sub-industries here, would benefit if Trump's elected. If Harris is elected, green energy, wind, solar, all that business. Healthcare. Now, I say healthcare, that's a broad category. It's not all healthcare. I would suspect that pharmaceutical companies would not do well, but like healthcare insurance companies, I read, and there was an expert saying that they would likely do well under Harris's stuff. Home builders. There's something about her giving $25,000 to new home buyers. That's the soundbite that I recall hearing and reading from several sources. So will that help home buyers? Yeah, but very, very quickly, that will put pretty big inflationary pressure on housing. There's already tight supply, and then you're just giving free money to people to spend on a house. Home builders are the ones who are really going to benefit from that, more so than home buyers. So we'll be looking at some of those stocks in a minute. Defense contractors. These days, Republicans, a lot of Republican stances, anti-foreign wars. It's different than it was in the past from my observation, but that's what it is. Harris said that she would stand by our allies overseas, and Biden administration has been doing that. So apparently Harris would be better for defense contractors. And then accounting firms too, because if you put that tax into place, every year you'd have to refigure out your net worth. And shoot, man, I mean, I don't know how to do that. I mean, I guess I can figure it out, but accounting firms are going to benefit by that pretty big change if they're going to force you to put your net worth on there. So let's talk about potential stocks. With Trump, clearly Chevron, ExxonMobil, oil companies, oil services companies. Chevron's a big oil services company. They're going to benefit under Trump. The banks, and we're talking the big banks here, right? JP Morgan, Bank of America, Wells Fargo, crypto companies like MSTR, that's MicroStrategies, Riot, Marathon. And then, the US focused manufacturers, which are smaller companies, mainly because it's been offshored for the past several decades. But if tariffs go into place and American companies can produce goods for the same or similar prices of China or whatever, those US focused American manufacturers are going to benefit greatly. So they're kind of hard to pin down. I'd have to do a lot more research, but it was suggested in an article I read that a good way to play that is just with the Russell 2000, these smaller companies. And there's a lot of manufacturers in there. So the RUT, the RUT, IWM, which is just the ETF smaller version of the Russell. Those would be good plays. Prison operators, GEO Group, GEO, and Core Civic, CXW. These are stocks put on your radar. Gold. Now, why gold? I don't know. I mean, I have some ideas, but the one thing that I do know is that when Trump does better in polls and such, and better on PredictIt and those gambling sites, gold goes up. And when Trump is trailing more in the polls, gold goes down. Just pattern recognition, correlation. Whatever the reason is, gold would probably benefit. And then DJT, which is Trump's company, and I have no idea how that company's stock price does anything, but it's my understanding that when Trump does well, that stock does well. When Trump doesn't do well, that stock doesn't do well. So whatever the reason is there, that could be a play. Okay, with Harris, start out with some renewable energy names. NEE is Next Era. It's one to keep on your radar. Plug Power is the name of the company. They, I think they do like hydrogen forklifts and such, if I'm not mistaken. BE is Bloom Energy. These should be on your radar. Humana, United Healthcare, these big health insurance companies are probably going to do better if Harris wins. Home builders, DHI is DR Horton, KBH, KB Homes, and then Lennar. These are the big home builders in the country. And then defense contractors, Lockheed Martin, General Dynamics, Northrop Grumman, RTX Corp. And then finally, treasuries. Now, you might not have seen that one coming, but it is thought that Harris would be less inflationary than Trump. And so that would lean more towards lower interest rates. And when interest rates go down, treasuries go up. There's an inverse relationship between price and interest rate when it comes to treasuries. So we would probably want to buy treasuries fairly quickly if Harris was elected, or at least I would like to lock in that higher interest rate before interest rates go down. And then accounting firms, the big ones, KPMG and such. I don't have that on the slide, but those would benefit. Okay. I'm going to open this up to a Q&A now. As I do that, if you like what you hear, feel I provide you value in how you think about fundamentals or technicals of the market, you can follow me on YouTube, Instagram, Facebook, or X. You can just, go to these sites and type in Market Taker Mentoring for 3 of them. I'm Dan_Passarelli for X. Or just take out your cell phone, aim your camera at it, at the QR code for each of them, and that'll get you on your cell phone. What questions can I answer about anything we talked about here today? What questions can I answer about anything we talked about today? Hit the Q&A box. Hit that Q&A box. And I'm glad to go over anything that can be helpful. You have any final questions? No? All right. Well, next week, we've got some more good stuff coming up. And we're back to looking at individual strategies, tactical ways to trade those strategies. And not this election business anymore. We'll be past that by then, I think. All right. Have a great rest of your day. This is Dan Passarelli, Trade Smart. I will see you next week. Bye.